I'll just show you the chart that Metals and Miners put here, and you can see that after around August, September, it picked up again, right? Because they had a deal. And it's been since then that we've seen these in 3 out of the last 4 months, right? That we've seen gold exports go through the roof. And I think there's a very good chance that it's going to China.
Our response as individuals is pretty similar in every case, right? We want to be moving into real assets. We want to have as much gold and silver and as much exposure to other kinds of energy assets and other kinds of real assets. And with the expectation that those assets will hold their value better than financial assets. So, yeah. And you asked about what kind of plans they might implement in the next crisis.
Gold exports have surged in recent months, especially since late summer, signaling a renewed shift in global capital flows. The acceleration suggests rising demand for physical metal, potentially from major buyers repositioning ahead of deeper financial instability. MarioInnecco, a macro analyst focused on monetary trends, and John Rubino, a financial writer and real asset advocate, highlight that this movement reflects a broader transition toward tangible wealth preservation. With gold exports spiking in 3 of the last 4 months, the data points to growing accumulation, possibly led by nations seeking protection from currency debasement. The main takeaway is clear. Both institutions and individuals should consider allocating toward real assets like gold, silver, and energy resources, which have historically preserved value better than financial instruments during crises. As the system faces increasing pressure, real assets are expected to outperform, especially if new policy responses or monetary resets emerge. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The title is "The U.S. has net settled in gold its trade deficit with China in 3 of the last 4 months. Why a higher gold price is now in the U.S. national interest." And when my friend who told me about this article told me that at first, I thought, how does he know it's China, right? And then I thought to myself, let me read this article because I think there might be something into it. So he says here, the sub-headline contained a piece of information so profound, so significant, and that's referring to the Wall Street Journal article, and so contrary to the last 2 decades of economic history that it should have been on the front page of every financial newspaper in the world. The deficit shrank because of gold exports. For the 3rd time in the last 4 months, the single biggest export of the United States of America by value was not soybeans, not aircraft, and not software. It was gold. This is not normal. That's Metals and Miners. In fact, it is so far outside the bounds of normal that it requires a complete re-evaluation of the role of gold, the role gold is playing in the global financial system. The United States is, for the first time in a generation, net settling a portion of its trade deficit in physical gold. This is not a statistical quirk. It is a tectonic shift, and it leads to a series of questions that are as uncomfortable as they are important. Number 1, who is forcing the U.S. to pay in gold? Number 2, why are they doing it? Number 3, where is the gold coming from? And most importantly, what does it mean for the future price of gold when the world's largest debtor nation is now incentivized to see the value of its primary settlement asset rise as high as possible? Makes sense, right? The higher gold price goes, the easier it is for America to cover its trade deficit. Let's continue this article, and it might be a while. It's not a short article, but anyway, you need to know. So a generational shift. For the 3rd time in 4 months, gold has been the single largest export of the United States, a phenomenon that has not occurred in at least 20 years and likely never in the post-Bretton Woods era. The U.S. is net settling a portion of its trade deficit in physical gold. Well, it means someone doesn't want fiat dollars. They want gold, and the U.S. is obliging it. So the China connection. The only nation with a combination of strategic leverage, a near monopoly on critical rare earth and strategic metals, a stated policy of de-dollarization, and the military to force this settlement change is China. Very good point. They are demanding gold for goods the U.S. cannot source elsewhere. The source of the gold is a mystery. Why is it a mystery? Isn't it coming from Fort Knox? Well, let's go on. The gold being used for settlement is not coming from registered stockpiles, Fort Knox. The U.S. officially holds 8,133 metric tons, but these exports raise the question of whether the U.S. is using undeclared gold acquired from other nations to meet these obligations. Here I'm going to chime in because I was speaking to my friend yesterday after I read the article, and I said, this is really good. And I said they could be using FASB, FASB 56, which is an accounting directive that President Trump actually signed or approved back in 2017, which allows the U.S. government and big U.S. corporations basically to hide financial transactions if it is important for national security. So they could very well be doing that. They could be buying the gold and leasing it to China or selling it to China through third parties like USA Tether, right? USA Tether has been buying loads of gold, and royalty companies as well, for that matter, which provide an income of gold every month, right, or every year. A higher gold price is now in the U.S. national interest. If the U.S. is now forced to pay for critical imports with a finite asset, gold, instead of an infinite one, dollars, paper dollars, right? It is now in the direct national interest of the United States to see the price of gold rise as high as possible to conserve its stockpile. The scramble for new supply. The U.S. is now in a race against time to build new non-Chinese supply chains for strategic metals. This involves fast-tracking permits, directly investing in miners, and forging new alliances. Until those supply chains are secure, the U.S. has no choice but to pay China in the one asset China cannot refuse, gold. So I'm not going to go through the rest of the article because it's really long. I'm going to put a link to it in the description. You might be able to read it for free because it could be your first article in metals and miners. But I also recommend subscribing to it. I'm not getting anything from it. I'm just letting you know because it's a good service. So, but he continues and he says, below I deconstruct the evidence, explore the China strategic metals connection, and explain why this quiet shift in trade settlement represents the single most bullish structural development for gold right now. And he goes on to touch upon the fact that last year, I think it was, sometime in the summer, Chinese exports of rare earths, intensive permanent magnets plummeted in mid-2025, right? I guess that's because China used its rare earth card against the U.S. But then the U.S. negotiated. They had a deal that I think it was back in October, and the LSE website reported on this. It says the U.S.-China rare earths deal shows the importance of critical minerals in the new era of strategic interdependence. So I'll just show you the chart that Metals and Miners put here, and you can see that after around August, September, it picked up again, right? Because they had a deal. And it's been since then that we've seen in 3 out of the last 4 months, right, that we've seen gold exports go through the roof. And I think there's a very good chance that it's going to China. It's not going to Iran or North Korea or to a less important country. The U.S. would laugh at them, at any other country except China or maybe even Russia, if a country said, "Oh, we want gold instead of fiat dollars."
Gold exports have quietly become a major component of U.S. trade, marking a shift in how global imbalances are settled. Rather than relying solely on fiat currency, signs point to physical gold settling trade deficits, indicating a transformation in the monetary system. The key implication is structural, not temporary. If gold is being used in settlement, potentially driven by demand from major trade partners like China, it suggests declining trust in fiat money and rising preference for neutral, tangible assets. This shift means higher gold prices are likely, as a rising valuation makes it easier for debtor nations to meet obligations using a finite asset. At the same time, complex factors like supply dynamics, hidden transactions, and strategic resource competition influence the system. The central takeaway is that gold's re-emergence as a settlement asset in top-level global trade reinforces its stabilizing role, and those seeking security should also focus on tangible assets. Let's get back to the interview.
We should move our capital out of financial assets like bank accounts and big cash balances elsewhere, and money market funds and government bond funds, things that depend on the value of the currency for their value, because the currency is depreciating at an accelerating rate, and we don't have the rules at our backs anymore. We don't necessarily own our deposits in a lot of financial institutions, so we ought to be moving now, gradually. It doesn't have to be tomorrow where you shift everything over, but we ought to be using dollar-denominated assets in the U.S. to buy things that don't necessarily have counterparty risk, can't be created out of thin air by governments. And in other words, we should be gold bugs if we're not already. We should be buying gold and silver. We should be buying to a lesser extent, the equities of companies that have real assets, oil companies, uranium companies, things like that. And we should just be gradually doing that, building up piles of gold and silver that are stored in a safe place, and that will come through a great taking scenario in really good shape. They'll take the financial assets before they come after the real assets. So that gives you time in which to make plan B and plan C if any of this starts to happen. You know that our would-be dictators have a saying, never let a good crisis go to waste. So they definitely have contingency plans drawn up for different kinds of financial crises. And presumably they've got a bunch of false flag plans drawn up for causing the financial crisis. But for stackers, for instance, it doesn't matter all that much, because we're going to do what we're going to do, regardless of whether the government causes the crisis or whether it's some geopolitical thing like what's happening in the Middle East right now, or whether it's some other country screwing up in some monumental way that bleeds over into the rest of the financial system. Dozens of catalysts out there. But our response as individuals is pretty similar in every case, right? We want to be moving into real assets. We want to have as much gold and silver and as much exposure to other kinds of energy assets and other kinds of real assets. And with the expectation that those assets will hold their value better than financial assets. So, and you asked about what kind of plans they might implement in the next crisis. And there will be variations of capital controls. And that can take a lot of different forms, but one can be you can't move your money overseas. Another can be we're going to really limit how much cash you can take out of the bank in any given transaction, or how much you can have of certain kinds of assets in certain kinds of accounts. All of that stuff is completely possible, and none of it is predictable in the specifics. We don't know exactly what it'll be, but it'll probably be something like that, because if you look at least American history, you see a lot of this stuff. They made gold ownership illegal in 1934, and they didn't make it legal again until 1971. So if we're capable of something like that, or if we have been in the past, then we're definitely capable of it in the future. And then there's there's all the AI surveillance that's becoming more and more possible, where they know what's in our accounts, they know what we're doing with our accounts, and if that's combined with central bank digital currency, which it probably will be at some point, then they're going to be able to control our accounts. So it won't even be mass capital controls necessarily. It can be very precise. You took part in a protest against the latest war, therefore we're shutting down your bank account, we're cleaning it out, and good luck paying your rent this month. That's the kind of stuff that can happen too. So you just want to be as far away from that kind of risk as possible. And without knowing what the specific risk is, it's just going to take the form of some kind of government control over our financial assets. And therefore, we want to be as far away from those kinds of financial assets as possible.
The shift away from financial assets toward real assets is increasingly driven by declining confidence in fiat currencies and the institutions that back them. As currency debasement accelerates and systemic risks grow, capital held in bank deposits, bonds, and money market instruments becomes increasingly vulnerable to both inflation and policy interventions. The core argument centers on reducing counterparty risk, which is crucial for long-term financial security. Assets like gold, silver, and energy resources cannot be printed or digitally restricted in the same way as financial instruments. Historical precedents show that during crises, governments often impose capital controls, restrict withdrawals, or even redefine ownership rights. With advancing surveillance systems and the potential rollout of centralized digital currencies, control over financial assets could become more targeted and immediate. In contrast, physical assets held outside the system provide a layer of independence and resilience. The main takeaway is to gradually reallocate toward tangible wealth, ensuring purchasing power and accessibility regardless of policy shifts. Positioning ahead of these changes is less about prediction and more about preparation, aligning with a long-term trend toward asset security over convenience. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.